S&P 500 monthly index, S&P 500 index right here below us. One of the things that we would like to point out is that the bull side of the S&P is in control of the market. One of the things that I want to focus with you is in the shorter term element, the shorter time element, is that we are at the 2011 calendar yearly high reversal. That was your bear move. Your bull side of the actual trend in our SMF weighted trend analyzer is that the weighting on the S&P and where the neutral point is going to be right around 1222.68. That's the neutral part of this trend on the S&P between the bull and the bear. That's your number, MMT, 1222.68. That's the neutral part. Right now on the upper end, the bull in our half delta SMF trend analyzer system at 1 half delta positive would be 1368.79 area on the S&P, which would mean that on this monthly chart, you're right at the critical mass levels with QE2 that started back here at the calendar 2010 low from the 2009 liquidity injection. This was your first round of injections, TARP, let's call it. Your second round was what we call QE2 by the Federal Reserve here that drove them all the way up into very high. And that was the bull high. Then the bear took over for 5 straight months. Both parties at 1074, the bull has gone from 1074 here all the way up here. This is the amount of run that the bull had. And I would be happy to announce to the MMT that you had 295.81 bear points on the monthly level to that bottom. That's how many negative bear points that the bear had control of the monthly S&P 500 index. Now, having said that, MMT, the current bull points from the very same low where it stopped, and we had called that bottom there, that low is 288.63 points of bull points. So you got your amount of bear points and bull points. Total round trip in the yearly cycle pattern from the bear cycle to the current bull cycle, you have had a grand total of 584.44 total bull and bear point moves. Now, what took it down was Europe here. What brought it up was Europe is going to get well. What I am telling people is that once again, the bull cycle has proved itself. The bear cycle had proved itself. The neutral part is that the S&P is slightly 3.59 handles away, 3.59. You got to get up 3.59 handles more to get to the overall even point of the full bull and bear move. I will tell you that in the short term, the events have ran their courses and the headlines and earnings and everything combined thereafter. Europe took it down. They came in, did worldwide TARP, and QE3 started right over in here. And we all know that every worldwide bank is throwing lots of liquidity in their system. And that the bull started its lower end of the move of a 2-month move. This yearly movement, and this is 5 months from the bottom up, but it's also 5 months to the bottom down, 6 right here from the top. What I'm telling you, MMT, that we are at a very critical area of complacency, meaning that there is very little fear in the marketplace. Yes, the bull has its great cycles and its great QE3. You got to remember, they're trying to save the worldwide economies, but now you're going to have Iran and gasoline going higher. Where does that change agent take place with the consumer that drives company fundamentals higher, that spend money. Once again, higher gasoline prices come back into play. We could get supply and demand disruptions in the food chain cycles within the U.S. Regions. We could have worldwide food disruption cycles that would cause the commodities that are our edibles that we eat in the commodity market go a lot higher, then the consumer would have to pay more money. So discretionary income, the reason why we were short here is because we were extremely overbought on the S&P up here, and that was the high end of it. And down here was a time to be long, and you have a 2-month rally. So both the bull has a great case with stimuluses worldwide, and buying bull trends at support levels and selling bull trends back into resistance levels will be the actual trade management. One of the key factors that we'll be looking for is what we call pre-market. That's before the stock market opens up. It's an hour and a half to the opening bell. There's an hour and a half in there called pre-market futures. What we will be looking for is bull market gaps, called bull market exhaustion price gaps, that if you're short up at those highs, the verification model in the trade management is they pull them back to the previous day's close during that time. That would verify, the SMF verification model would be right up there, and they would be selling it down to the opening bell. At that point, you would look at taking that bull support level higher and or let it go down a little lower and then cover and get net long. And the range today, today's range is going to be very key in S&P 500 stocks. It's going to take the overbought level. It's going to take a lot of money to get this through this level. That means that the upside in our system, we're looking at if they can get above 13, a half a delta would be a half a delta bull trend above the bear, meaning that the bear, the bull, is a half delta in our system. Our trend analyzer system is that the bull delta that we use and calculate as a price movement is a half a delta up on the overall yearly trend between bear and bull, or bull and bear. Doesn't matter how you want to factor it. And why are support levels and bull trends, why do they bounce off support, whereas when you're in bear trends, you're always shorting the high and they come down and they break support levels on the way down? They don't, yes, they do hold a short-term support level. Yes, they do bounce, but they roll over, make lower lows, but then why do they make higher highs? And where is the bull exhaustion going to come into play? I will tell you on the monthly chart, when we go back and we look at other time frames, I can go right back over here in this monthly chart and I can draw a trend line, and I'll be happy to do so. What I will tell you is they're at 1436 on the S&P. That this is going to be that 2008 counter rally where we were, oh, it was a great short there in that time. But this is that upper end. There are going to be other levels that come in play. I'm just letting you know where the 2008 reversal was on its first 3-month move. It's right here at this upper trend line. It's right there. And then bam, you went straight down forever. So we know that. Now, that's where that trend line comes from. It's very important to have that one pegged. The other thing that we're going to be looking at horizontally is where does the top of the bull bar is 1400.79 at this second reversal monthly down bar that occurred on 6/1 of 2008. So if you do break through there, you can easily see right below that 1400 level. Now, in the SMF bull analyzer, if the S&P was to break above that 1368, your 5/8 bull delta in our system would be 0.63. It would be up 15% on a monthly level, and that would be at 1405.31 MMT. in the actual bull analyzer. The bull analyzer is very strong. Now, because we're overbought, a pullback, if we don't close above the half delta of 1368.79 in the bull, which MMT would equal a 12% move from the neutral line of 1222.68. And that's a 12% move to the positive side of the tape. And the more positive that the tape gets, there is very little short interest now. Because when we made the bottom, which was negative 1/2 delta, that was 1076.57 in our system, and the monthly lows were back, or that low was right here, and it was 1074 right here. So in our system, you went from a negative 1/2 delta. That meant that all that short interest that was on top of the market, that had the Greece and everybody else involved in it, everyone knows what that is that short interest in the exchange model had to be buy to cover. It had to be bought back. When you buy that short interest back in the broader S&P, you get these moves in this directional bull side movement, just as you did the bear. That means that when the bull does have the pullback, there's going to be little short interest in the market at certain lower support levels, meaning that as each support level in the bull pullback gets exhausted and it goes down to the next support level, the market is overbought on this monthly level, and it's at the major resistance. The upside movement says that at this particular movement, 1268 or lower on the S&P, is that the bull has ran 288.63 bull points. And because of it, it's created in a very short macro time period a very overbought condition on a monthly level. And on this weekly level, we are at a weekly resistance level of 1364. Okay. We can go back in other periods of time as I have gone, and this will apply on all the other indexes, MMTs. But it's important for you to know where the bull cycle is and how bull cycles operate versus bear. But we are coming up. When I go back over to 2008 on this weekly level, I can see 1381 up here. That's this trend line right here. And on the weekly level, we're going to consider it a bull bear top resistance level. So the bear starts here and the bull's got resistance where the bear started. Now, bull trends can continue to go higher. However, the upside in the very short macro term is limited because we're hitting a wall of bull, short-term bull exhaustion. And I'm going to draw a trend line right here. And I'm going to go to the trend tool, and I'm going to draw it right there for you, MMT. That's at 1399. That's at 1400 handle. I'm also going to go right here very quickly, that 1390.99 handle, and these are going to be the areas in the short term. Right below here is going to be that 1373 handle going right up the tree here. So, once again, we break through this trend line, we're going to be looking at that weekly one right up there, and that's got 1373 handle. That would put the bull trend higher than where this original reversal trend happened in 2011. And that's this weekly movement that we said that 1370.58 on the S&P was the reversal, and then the bear took control right here. And the bear took control huge. The bear points were 295.81 bear points from that 2011 reversal that we called for. Now, MMT, I'm going to be happy to say to you that you're 95% overbought, and this is what it looks like in that time frame. If we get up to that 1373 handle, we will be at a maximum point. But remember that when you break tops, you have to break them on what? You'd like to break them on higher volume, but you'll take the lower volume. It doesn't matter in these markets today. But what does matter is this time frame right here. This is the time frame that the bull is headed to test again. Now, whether it makes it there, we'll determine that tomorrow. But 518 here, 518 of 2008, just so everyone knows, that's where the S&P was at 1425, 1440, and the low was 1373. That's the current upside resistance. We're at 1361.23 closing as of Friday. Today is 2/20/2012, Monday, President's Day. Happy President's Day, everyone, because MMTs, you're getting the real deal here right now on President's Day. And it's about you understanding where that bull is and where that bear is. But this was a very special point of time back in May of, and this is where it started. That's why this whole area in here, this 1373 trend line that I drew right across here, let's make sure it's all in the video. That's right here on the weekly. That's where we're at. That's a resistance. That's a resistance. And you have other little ones in the point, but it's all going to go back to this key area that we were involved in this on 4/27/2008. We were here every day. 5/4 here. Here's a weekly of 5/11, but here it was. 5/18 high, 1440 on the S&P. Now, this is back in that time frame, so S&P 500 will trade in a range within the 5-day period. We have had a 2-month bull breakout in the range, and that's this bull breakout right here. Here are bull tops that I was showing on a weekly. This is back in that 2008 period of where I was telling you. And the thing about it is we're at this monthly level, but let me tell you, at 77 and on the weekly level down here at 95.59%. Once again, why do we master where the exhaustion part is in price and the indexes? But does it matter? People have been waiting for the last 10 years since this reversal happened on a monthly level. In year 2000, we were here every single day. People have been waiting on this S&P, and here's a 2007 high reversal that we were involved in. They have been waiting to get this thing or have a reason to use enough stimuluses and worldwide that you could break this S&P all the way up there to where the 2007 reversal was, but also the same reversal in year 2000. Look what happened to them. They got mutilated to the bottom. It was time to go long. 2007, they came all the way back down here. Look, they never thought they were going to get down to those levels, and they did. And the bottom line is, from the 2009 bull cycle, you have a bull calendar year, you have QE2, and a second big reversal in 2011, and back on the monthly level, we're coming right back up to the major resistance levels here. But let me tell you something, the bull has to have a reason to take a profit, because they do. And higher gasoline prices at $5 or $6 and any short-term commodity and or energy disruptions could put a little damper there, because remember, the bull is already in that exhaustion price area in the indexes. The short interest in the indexes have been removed on this bull rally up. The bear accumulates short interest in stocks and indexes and futures and all kinds of other things, but it's all been wound off of there. And we're right back once again with another worldwide stimulus program. Otherwise, you would not be back up here at these monthly double tops. You would not. And back in 2010, when QE3 started, this was the 2009, the 2010 bull top high. This was that lateral. This is where QE2 came in, right here in 2010. So you know. Now, stimulus, TARP, QE2, QE3. and it's taken a number of stimuluses. Now you got the rest of the world tarping up and stimulating their banks and doing everything across the board. That's the bull case. That's great. The bull can only go so long before it has to have what we call a bull rally shakeout. A bull rally shakeout is that the buyers that bought into the move are that you drop down and you test support levels in our trend analyzer, which would be right around, let's say, a positive 1/4 delta, 1295.73, that's 0.25 ratio, that's 73 handles below the marketplace from here. But that's where the indexes from overbought cycles, whether they're from this resistance level or whatever resistance level it is and will be, the bull would have a reason to take a profit. The earnings season is out of the way. Almost. We got a couple of bellwethers, Priceline and Salesforce, CRM coming next week. It doesn't matter. What matters is that the bull rally from the bear bottom to the bull rally closing price here on this level right here. This month is February, January, February, right here. And we are taking out right now that 1369 is a wall of resistances, but right below 1400, and there's some tight pockets in there, in between there now. And that in the short term, we are extremely in the bull phase over bot condition, where the bull has to pull back so that other bulls can enter the market. This is the story and the truth of the monthly movements that have happened going back to year 2000 cycles. We had the complete topping patterns here. Look what happened. They never did get to the bottom, though, until they got down here. Then we had a big stimulus plan that came in, and we had the Iraq war. We did, right here. And in 2003, that war created stimuluses, because it did. And this is where that total expansion from during the Bush administration and during those years that we started that war, and we had a lot of stimuluses. And so what is stimuluses? Those are monetary dollars that are being, to monetary base is what it is, and lots of dollars are going into it, and it failed, and it lasted for a great bull rally, but it failed at the top. Boy, did it ever fail miserably. And we were doing the same thing then. That this is how far that bull had got, and then, of course, we were short into 2008, but here's that monthly 2008, and the bull, every bull, or every new bull, the question of it is when you get on the S&P 500 is how will that S&P 500 by calendar year end get back to 1500 right here? Well, you would not, okay, lots of things would have to happen. But monetary value, the stimuluses that they're putting in are only going to last for a period of time. And if the Bush, all of those tax cuts, if we start 2013 with those new tax laws that would take place, would put this U.S. economy in a double dip recession. And that is going to be at the end of the calendar year here. And what it means is that markets, nobody ever thought in their wildest dreams that the S&P would come right back over here to the 1996. We had a great expansion. And remember, we were coming off between that 1990 period all the way up to where the stimulus started working in 96. And we went through the Gulf Wars and we did everything. But listen, you only went to that 2000 exuberant high and it gave it all back. It gave it all back. It gave it all back, and that was the first big bear that came into play. Then we had the Iraq war, and all of these stimuluses, my friends, my true friends that are involved in the market, whether you're from the very biggest player to the very smallest person who's trying to buy a good name and make some money on it and invest in good companies, and bless all your hearts for that matter, is that all of these stimuluses don't work. Look what happens. They give them all back up. This one failed. This one failed. And so far, this one had a calendar 2011 reversal, major. And this is our major update for people in the MMT yearly school. Because it's bull trends have to pull back. And you can get them, it's going to take a lot of work to get that thing back up here, I can tell you. And I'm not saying right away that we're going there, but I'm saying that this year, all the TARP stuff and all that good news and everything that's taken this bull trend. So what is a bull trend identifier? Or how do I really know where this is coming from? It's all based, Europe took it down, and all the news coming out of Europe in calendar 2012 has brought it right back up where the fiasco started. Now, having said that, moving forward, we're overbought, and the bull rally is exhausted. And any disruptions around the world, whether it be Syria, whether it be the Middle East, whether it be with Israel, Iran doing this, doing that, whatever the case may be, it's where supply and demand, short-term supply and demand issues could come in and give the bull a little bit of discomfort because the bull is extremely overbought going in to these forward-looking events that would trigger the pullback in the S&P 500.